All right, hello from Volcano, California. Let's see if I can't walk you through some of this really quickly. So we have initial capital expenditure of $720,000. It's going to last over 10 years with a salvage of 80 and no resale value. That's going to give us then depreciation, which will be $64,000 a year. Then we have our revenue starting at 585 and then growing by disparate numbers 3, 5, 6, 8, 8, etc. 3, 5, 6, 8, 8, etc. So just be careful with your data entry. And then our formula is going to be the previous year multiplied by 1 plus that growth rate, and should get us to 940,000 in revenues by that last year. Then we should have cost of goods sold as 31% of revenues, which is constant, and then operating expenses as 42%, which is constant, and then the tax rate of 24% with a required rate of return of 7.5. So we bring the revenues down from up above, then we multiply it by cost of goods as a percent of sales, do our subtraction there. Our operating expenses should be also then as a percent of sales, and we'll get ourselves down then to include and show the depreciation. And then our cash flows from operations are 135,402 based on that depreciation plus the net income, and the net income varies from the 71,000 to 144 by the end. Our initial capital expenditures would be the cash flows out of that initial investment of $720,000 plus the working capital of $65,000. That working capital of $65,000 then also needs to be added back, and I did that over here by taking the working capital and adding it to the revenues for that final period. And therefore you see that our cash flows from operations in that last year won't match our cash flows net down below, because of that. Up here is primarily revenue and expense based, but until you get to last year, it's revenue and expense based, which is what this is based off of, but it doesn't include that salvage value, or sorry, the working capital value. So it will deviate a little bit, and ultimately I ended up with a $371,000 NPV, which was roughly 16%.